What does a professional trader at a hedge fund do? First and foremost, protect the capital of their clients, so their investors. Make money in rising and falling markets. The professional traders are known as portfolio managers, PMs. And their only function is positive selection portfolio. Positions that they actually want to have. There's no market making activity. Their function is similar to the proprietary trading function, but it's 100% of the time. The only difference is just the nature of the business they operate in. So let's have a look at the differences in the nature of the business. So, investment banks, where does the capital come from to allow an investment bank to operate? They're public companies. They've got public shareholders. When you invest in the investment bank's stock or their debt, if you invest in the investment bank's stock, you're giving them money to go out and generate business in primary markets and business in secondary markets. That's what you're doing. You're providing the capital for them to do that. What you do with a hedge fund is different if you invest in a hedge fund. So what are these guys doing? Well, the clue is in the name, hedge funds. They're usually hedged. They're hedging out risk. And they've usually got diverse long-short portfolios. And really, a hedge fund is just simply a business structure. If you have a certain type of structure, you're a hedge fund. So it's just the way the business is structured. And there's two entities that you really need to focus on for the purposes of today. It's the management company and the offshore fund. So you have an onshore management company and an offshore fund. The management company typically charges 1 to 2% to manage the assets under management, the AUM. And an annual performance fee is charged on the fund, on the assets of the fund, when they make money. But something that most people don't realize is that performance fee doesn't automatically just go out of the fund and everyone gets paid a big bonus and everyone goes home. Funnily enough, the investors want to see the hedge fund manager invested in their own strategy and happy to invest every year. So typically what you will see in the mandate of the fund, in the term sheets, before an investor invests, they'll want to see that the portfolio manager is contracted to reinvest their money all the time into the fund every year. So typically, they'll be reinvesting at least half of the performance fee back into the fund every year. So what does that mean? It means they trade their own money. Banks, investment banks, traders there trade public shareholders' money. Professional traders at hedge funds trade their own money and outside investors' money and charge a performance fee and a management fee to do so. Now, because the hedge fund trader is spending 100% of their time on the positive selection portfolio, so there's no market making, their trading and investment process is a lot more sophisticated than the guys who are prop traders at investment banks. They're much more thorough in what they do. This is the structure that you can go through of a typical hedge fund when you get the presentation. But for the purposes of today, because we've got a bit of limited time, just to understand the onshore management company and the offshore fund. So let's have a look at an example of a $1 billion hedge fund. A hedge fund that's got $1 billion of assets under management. We're looking at this because the $1 billion number is the number in the industry that's considered to be the level at which you've arrived as a hedge fund. Below that, everybody's trying to get to $1 billion. That's the golden number. So typically you can start off with 50 to $100 million these days. It's still quite difficult to get, but you're aiming to grow in 2, 3, 4 years up to $1 billion. That's when you've considered to have arrived. What are they actually doing? Well, in this example, we're looking at a fairly conservative $1 billion hedge fund, holding 25 positions long and 25 positions short in their portfolio. So they've got a self-imposed position limit of 2% of assets under management. So no single position can be over $20 million. And that will actually be in the terms of the fund before the investor invests. It's one of the reasons why they're investing. And they're targeting a 20% return with mid-teens volatility, 15% volatility. So it's logic that you would want to get a 20%, if you're targeting a 20% return, you would rather invest in somebody who has 15% risk and achieves 20 than somebody who has 40% risk and achieves 20. These numbers will be in the mandate and the term sheet as well of the hedge fund. It's the reason why people invest. So in this example, they're charging investors a 2% management fee. Just for the record, 2% is very high. So this hedge fund's getting away with charging 2%. 1% is the industry standard. And they're charging a 20% performance fee. So they're making 20 million in management fees and 20% on the performance, 200. So they're making 40. And then 50% of that performance is reinvested by the managers. So at the beginning of next year, the $1 billion fund becomes 1.16 billion. 40 million has left the fund. 20 million in management fees and 20 million in performance fees. Now let's think about that management and performance structure. First of all, let's deal with the management company. The management company is onshore and invoices the fund offshore for the management fee annually. Why? Huh? What's that 20 million used for? Yeah, the 20 million is used for all the infrastructure of the fund, to run that fund, including basic salaries of everybody in the office. Where's the performance fee invoiced? Offshore. Because the fund sits typically in an offshore tax haven. No one likes paying the tax, least of all the investors. So they invest in the offshore entity and the traders charge the performance on the offshore entity. Then they don't need to bring it onshore. They can reinvest it and keep profits offshore. So what does all this mean for you guys? The professional traders at investment banks and hedge funds, now we understand what they typically do. Let's summarize it. Hedge fund managers use their own money to trade. They reinvest and they're invested in their own fund. They also accept outside investors' money and they charge to do that. Traders at investment banks don't. They trade public shareholders' money. And they spend 80 to 90% of their day managing a commission revenue business and trading out of positions that they don't want to have. It's a totally different function. The commission business at investment banks, unfortunately, has been in structural decline for over a decade. It started in 2002. You just shouldn't believe what you read in the media, because they have a different agenda. They want you to buy the newspapers, they want you to watch the television and watch their program to get ratings, and they want you to hit their website. So they will sensationalize everything. Your perception is completely misguided. In this market, senior professional traders at most investment banks don't get paid more than $300,000 a year. That's basic plus bonus. Junior traders get significantly less. And both of them exist month to month. So we're talking about putting their card in the ATM machine at the end of the month, and it says zero or has a negative balance. They exist. Because the senior traders have all got whopping mortgages in central, west, north London, wherever. Their kids are in private school. They've got expensive lifestyles. What goes in, goes out. It has another consequence for you that you need to understand. If there's no opportunities to make money at investment banks, do good traders go and work at investment banks? No, they've all left. They've all gone to hedge funds. They've all left the Western world altogether, or they're operating in the Western world and doing their own thing and trading their own money, because they can make more money doing that than working at an investment bank. What does it mean for you guys? It means your expectation of the training that you're going to get when you go to an investment bank is completely misguided. Because you're going to be learning from the crap. All the guys that are left over who can't move to hedge funds, who don't have the talent, who don't make money trading, and don't have enough money to trade with their own money. That's what's left. You're going to be sitting next to them, learning how to trade off them. And they don't even know how to do it themselves, because all they do is stick things in a machine. There's also another consequence to this, and we call it in the industry the race to zero. These algorithms, which are so prevalent in the industry, have destroyed all short-term opportunities in publicly traded assets to make money. Because that example that we looked at before, where the machine is buying on behalf of the client $10 million of Apple at 500, there's machines built to predict what that machine is doing. And they buy the Apple before the machine buys it and sells it back to them at a higher price. And there's machines built to predict the machine that's predicting the machine that's buying Apple. So how many trades do you think an algorithm can do in a second? So you're looking at about 15, 20,000 with decent algorithm. How many can a human do? One. But humans literally don't stand a chance. This race to zero is everything in a short space of time. So we're talking a second, a minute, 10 minutes, an hour, a day. The human doesn't stand a chance. The machines have replaced humans on electronic exchanges in anything under a day. You don't stand a chance. And if you look at implied volatility, of publicly traded assets over the last 12, 15 years, it's just gone like this, constantly down, over short time horizons. And that's what we call the race to zero. Because all these machines are competing all the returns to zero over short spaces of time. So you either need to become the best programmer in the world if you're going to be successful in trading, or you go where the opportunities are. And the opportunity now is not to go to the investment bank and make money over one day because volatility is really high. Those guys stick things in machines. The opportunity as a human is to add value by learning how to manage portfolios and trade portfolios over 1 to 3 month time horizons, longer time horizons, because the machines can't do that. Humans can do it. So that's where you add value as a human. It also gives you another strong message. All the good guys are leaving, or have already left. And now they're trading either at a hedge fund structure with their own money, or they're trading in other structures with their own money. They're sending you a very strong message. You need to trade with your own money. If you want to be a professional trader, that's what you have to do now. You can't go to an investment bank and trade with publicly available shareholder money or public shareholder money and get away with making tens of millions of dollars. It's not available anymore. It doesn't exist.